Well, Ashley, I think we're close enough to 9 o'clock that we can go ahead and get started. If you want to hit the record button, we'll officially kick things off.
All right, we are recording.
All right. I want to welcome everybody out to the May AgriSompo North America Edge Group's marketing meeting. We're glad to have everybody on here from Ashley and Sterling and myself. We've got a lot to talk about, and it seems like each week I think, well, these are going to last 30 minutes, and we find ourselves at the 1 hour mark. But to lay things out, Sterling and I have kind of visited early this morning, and if you're on the meeting early, you heard this, but we're starting to get that red flag waved in a lot of places in the U.S. when it comes to the markets. So I know the first thing on farmers' mind are getting a crop in the field. And then about the time they get that crop in the field, they start to find other things to worry about. And it seems, from at least what my phone indicates, that we've got a lot of worry over the market. So Sterling and I are going to take a look at some things today that might give us a smidgen of optimism and look for how to identify opportunities that this market gives us. And we've also talked about maybe putting out a little 10-minute blog on this sometime in the next couple of weeks that you can share with farmers or agent meetings if you've got some of those. Before we get into the markets, I'll tell you a little bit about what's going on in my world. Last week, I spent a few days in Washington, D.C. On Capitol Hill, working with a lot of legislators on Farm Bill ideas. I'm going to give everybody just a quick update, just a few minutes on what's going on there. First, most of the folks I met with there, senators and representatives, are folks that we would call proponents of the ag portions of the Farm Bill. And so there was a lot of optimism overall. The timing of the Farm Bill is in question. And probably the biggest enemy to getting a farm bill passed in the next few months is probably going to be this debt ceiling argument. And if we don't get something done there, obviously the farm bill being passed gets pushed off. But there's a sentiment on both sides of the aisle that maybe it's an October or November type farm bill. There's already portions of the farm bill that are being written. So they're making some progress. AgriSompo, we carry a couple different messages, and it's things we are for and things we are opposed to. And we found a lot of common ground in those concerns and the things that we want to promote amongst both senators and representatives on both sides of the aisle last week. One of those is you may have gotten some calls, if you're a farmer out there, of lobbying groups, wanting some money to lobby against means testing. And means testing, it's a very ambiguous term, but essentially if you have the means to pay for a higher percentage of your crop insurance premium, you will, versus those that do not. And of course, it brings up a lot of questions of how do you qualify for that? Is it something on your tax return? Is it something on your balance sheet? And those are all things that are up in the air. We want to make sure that we don't incorporate any kind of means testing when it comes to crop insurance premiums in the Farm Bill. The second thing is, and we didn't really find any opponents to this, we want to make sure that all the Farm Bill stays together. There's some talk out there of some extremities in both parties where you may want to split that Farm Bill apart, something on the conservation green side, something with SNAP, and the help with the food subsidies in a separate bill, and then you'd be looking at the disaster payments and the crop insurance in another. And what that does, it essentially creates a situation where you don't have that bipartisanship. So by keeping everything together, things seem to flow a lot better. And I didn't get the sense that was necessarily any kind of mainstream idea when I was out there. So things seem to have gone very, very well. And of course, we've got representatives across the company that will be out there for a few other dates in the future. I don't know if I'll be back out before the Farm Bill gets passed, but it's certainly an honor to get to go out there. One of the highlights is it's a busy day. We started early in the mornings and worked into the evenings. But one of the things that I got to do was Representative Mann from Kansas gave us a private tour of the Capitol one evening. about 9:30, and I should have shared some pictures of that. I got some great pictures on the inside of the Capitol building, and it was just pretty nice to walk through. I'm sure some of you have done that in the past. It was really my first walkthrough like that. So optimism on the Farm Bill. As far as funding for the Farm Bill, didn't hear anyone argue that the funding from the 2015 bill wouldn't be available. And I heard a couple of points of optimism that there may be more money placed into it. That is yet to be determined. And of course, a lot of that has to do with what's in the budget for it. So over the next few months, we should learn that. But the Farm Bill seems to keep rolling. We've got a big presence out there. I think you would probably be proud of AgriSompo's efforts. I was out there with Bob Haney, and I can attest to this. When there's questions on crop insurance in the Farm Bill, Bob is one of the leaders on getting those answered. So I was happy to share some time with him out there. So on to the markets. Sterling, we've got a lot of people that are hitting the panic button right now. What say you? Is it time to panic?
It is never, ever, ever time to panic. Panic is how bottoms and tops get made in markets, because somewhere in here there's a low. It may have been today. We'll see, but we don't want to panic, because right now the situation, and as we mentioned in previous meetings, that risks to the downside were beginning to outweigh risks to the upside. And the market has now realized that, and we have seen the downside. Eventually, you push prices low enough, that changes. The scales turn and tip and increase the balance to where the risks now move to the upside. And I think we are getting pretty close to that point, particularly with new crop corn and soybeans.
In our chatter before the call, Sterling, I think one thing is to start with is we had our numbers from WASDE in May. Hopefully you guys got to tune into those our live call there. But it was our first look at where we think we're going to be in August of 2024. Now, put this in perspective. It's May. It's month 5. August is month 8. We've painted a picture for the next 15 months. And we've painted a picture, and maybe I shouldn't say a perfection, but near perfection. Sterling, what are all of the puzzle pieces that have to fall absolutely together to make those numbers work? I guess start with acres in the U.S. I mean, isn't that where we start?
Exactly. We need to hit, a perfect number of harvested acres, meaning we don't have much in the way of extra slippage other than what the USDA normally builds in. That's the first thing we have to do. So we'll just see how that plays out. The second thing is they put the yield at 181.5. That would be a record, and not a record by, let's say, half a bushel an acre. That's a record by 4 bushels an acre. And for that to happen, we are going to need nearly perfect weather everywhere. And I can tell you, sitting right here in Nebraska right now, the weather is a far cry from perfect. In fact, I'm basically treating my lawn with the same drought mode that I went into last year with extra intensity, because I'm not digging that thing up and planting it again. And the weather pattern so far, we have not seen anything with the ENSO shifting to neutral. It's been the same weather pattern where the GFS puts rain in the forecast and the rain doesn't happen. In fact, I'm thinking about creating a new index for this, the Sterling top-down index. And I think right now it's limit up for the next week. There's a chance of rain, but that rain, every time I check the forecast, it gets smaller and smaller. So my guess is it's not going to rain tonight.
So we've got acres, we've got yield. What else plays into this? We've got some usage numbers. We feel pretty confident in domestic numbers in the U.S. when it comes to corn and soybeans. I think we're going to be pretty solid there. And then we turn to exports. And a year ago, we just talked about this prior to the bell, we had aggressive export numbers. It looks like they're going to come through on soybeans. It looks like we're going to fall well short of what we thought we were going to be at 12 months ago on corn. Now, we've adjusted those, but could there be any surprises out there? There's two components. I don't want to boil things down too much on corn exports, but we've got Ukraine. They play a role in that. And we've got China. What's going on there? I mean, China's been absent. They've been AWOL from purchasing U.S. corn. Ukraine, mainly a political tool with that Black Sea corridor being open. I think at this point in time, we have to think it's going to be open. Any news on Ukraine and China that's going to affect that usage?
Well, for the Ukraine, we are probably going to be looking at material crop losses. The yields they are simply not going to have the crop that they've been able to supply the world with the last 2 years. So that is a positive on the balance sheet, in that there will be other places that are going to need corn and wheat. And we'll see how that materializes. Some of this also depends on the Russian wheat crop, which has done pretty well. But we can assume that the Ukraine is going to be noticeably smaller. The war is drug on much longer, and there's no sign of it relenting. And that is going to affect use, availability of chemicals, equipment, etc. That is going to be a problem. On the other hand, we have China. China just came in and canceled another corn sale a couple of days ago, and China has not been an interested buyer. They want to buy corn from Brazil, and Brazil's crop was quite bountiful, and that's now making us the country of last resort for them in terms of exports, in terms of them coming in and buying it. So we have seen some seasonal buying sometimes in May, with them just canceling orders over the last 4 weeks. I find it pretty hard to feature that they're going to come in and buy much. It is possible that with the lower prices that they may step in and show some interest. That is possible.
Well, let's keep our
Along,
fingers crossed for this. You made a really good point in the previous marketing meeting that maybe, just maybe, that, we don't have a lot of history on Chinese purchasing of U.S. corn. We got about 2.5 years worth of history to really go off of. But May 20th has been a good week or good time period there for China to step in. Doesn't look optimistic, but maybe there's an outside shot. We see them show back up. To Sterling's point, the price is considerably cheaper today than what it has been. On Ukraine, just to kind of add a little color and a little history there, 15 months ago, Sterling and I did a special edition on Ukraine. And one thing to keep in mind is they've supplied the world with a lot more corn than we thought. But some of that corn was actually the crop from 2021. So in February, essentially, there's a knee-jerk reaction in Ukraine of last year. Not a lot of corn in the bins from the 21 crop that actually got exported. So they had a substantial carry in even after the 2022 crop was harvested. The 22 crop, we had acreage slip, we had yield slip. But when you took that old crop supply, added it to that 22 crop, it was substantial. And then the surprise came with how much they were able to get out of the country. And just to kind of refresh folks, we normally, in a peaceful year, would have expected last year Ukraine to supply around 1.3 billion bushels of corn to the global market. That number's probably going to come down. And of course, we won't know this until August. Probably going to come down to around 750 million. Still much better than what we thought. And then Sterling talks about the crop we're getting ready to plant and our planting. Keep in mind, when you see pictures of Ukraine farms, their supply chain is different than what it is in the United States. You don't go pick up your seed the day before you're going to plant. You don't go buy your chemicals the day before you need to spray. You don't even buy your fertilizer the day that you're going to spread it. Most of this stuff is on hand. It's a little different system. There's a good chance that those inventories of all those inputs I just talked about are not on hand. The other thing to keep in mind is a year ago, we didn't know how much of the country would have been affected by battlefield activities, by the war itself. We're starting to get a clearer picture. And Sterling, there's a tremendous amount of primarily wheat ground in the east that where a year ago, you and I might have said, well, we don't know. It's a 50-50 shot as to whether this gets planted. We know this year there's a 90% chance it does not get planted. So there's a variable there we don't know about.
Yeah, and that is when I look at this, and on the bullish side of the argument, we put that. Then we have to consider what China is going to do. The Chinese reopening, which was the much touted thing that they were going to be buying more crude oil, we're going to see their hog supplies amp up, things that would naturally make them import more items. That is not happening very quickly. It is happening much slower than anticipated, which, okay, that's probably good for the price of gasoline, but they're not in here buying corn, and they're not in here buying soybeans, and their new crop purchases that they've made in previous months have not been very stout. So when we look at exports sales, and you'll see the report tomorrow, the email team is taking the day off today. They're celebrating someone's retirement, so tomorrow will be a double blast. But you'll see that you have new crop and you have old crop, and those new crop purchases have been lagging. So they are behind in terms of their purchases. Now, whether they come back in here as the summer goes on and start buying more, we'll have to see. But right now, they're not being the purchasers that we have become accustomed to over the last 5 or 7 years. They're being much more like they have been in the previous years.
Yeah, I see Aaron popped a question in there as to what type of wheat that is in Ukraine. Ukraine's kind of got the same situation we've got here in the U.S., Aaron. They do a fair amount of durum wheat there. Hard red takes the day. There is some soft red as well, and maybe one other type. Sterling, can you clarify? Do you know the quantities of each one of those?
I do not know those off the top of my head. I'd have to pull those up from somewhere from the USDA. But you can assume their wheat profile is really very similar to ours. So, everything is going to take a hit, pretty much across the board.
So Sterling, we've kind of thrown some things out there. We kind of know the bearish side. Of the bearish side, I think you can sum this up: lack of corn exports, speculators exiting long position at probably a pace that we haven't seen them build length or get out of length in a long time over the last month. We've got anticipated corn acres and bean acres increasing on both sides this year. We've got yields that would be the highest yields. Now, it's a scientific number. It's a yield trend number. It's not that the USDA is stepping out saying we're going to have this astronomical crop before it's planted. It's science. I mean, it is a yield trend, but we've got some pretty lofty numbers there. That's what we've got going against us. You mentioned the Ukraine unknown. Okay, that's number one. There's something else unknown, and we talked about it right before the opening bell here, and that's weather. And I know that we talked about things going on before we started to record. Let's talk about this weather situation right now. You keep your pulse on things very well. Are there, outside of what you see in the Western Corn Belt, you're living it firsthand in Nebraska, what else are we looking at when it comes to weather right now?
Well, down by you, we're seeing it's a bit soggy. In Iowa, the eastern half of the state is doing pretty well, and they can probably survive one high pressure ridge. The western half of the state, our drought is beginning to spread and starting to move into the western half of Iowa. So if we use Des Moines kind of as everything west of Des Moines is a problem area, going east of Des Moines, the situation is really pretty good right now. Now, this is going to change, and something that has come up in some weather discussions is some phenomena in the Pacific Northwest that can lead to blocking high pressure, which can also be called a high pressure ridge. It can be called the Dome of Doom. And if we see those develop, and we have seen some signs of that beginning to show up in Manitoba, that can portend to a drought in the Midwest. Also, in today's drought monitor, I began to notice a little bit of drought forming in South Carolina. Now, why is that important? Because Midwestern drought often starts with a weather pattern that causes drought on the coast in South Carolina. So that is something that should create what we call risk premium in the market. Right now, there is no bullish news in the corn market, and the market has priced things to perfection. And that is something that if we begin to see weather problems develop or they become more material in more of the country, that's something that can start to squeeze the funds a little bit and create a situation where we can see prices rally. Now I'm going to switch over here and I'm going to share a screen with you. And
Sterling, as you do that, just to keep in mind, it's easy to get pessimistic when we hear these projections for 15 months from now, but the here and now, the known, is that stocks are still relatively tight. They're extremely tight on beans, okay? You can kind of make the argument that we're going to be out of beans in a lot of places in the country. And corn, while we've taken that carry out for this August up from 1.1 billion to 1.35 billion, that's still a tight number. So we're starting off with not a lot of excess, and the market should reflect anything that Sterling just talked about in weather should be reflected in price premium.
exactly. Now, this blue line right here is the current speculative fund position, not counting the index funds. And as you can see, we have gone, this is zero, and we've gone from at least a small long, and we have come down here to where we have created a pretty good sized short position. This short position exists for one purpose and one purpose only, to make money when the price goes down. As prices go down, the willingness to pile in and sell becomes less and less. And we have some things here that over the near term that can help us. One, we have a holiday weekend coming up, meaning I've made money in the corn market, and these guys who are short have made, they're up 60, 70 cents a bushel right now. They are going to be very careful about guarding that. We also have June quarter end. So if we get any ideas about the weather, suddenly it doesn't rain here for the next 4 weeks, which is a material possibility. That is something the market sees right now, but isn't really believing. The market will start to believe that. If that line from Des Moines, if that moves to Davenport, Iowa, if that moves, to Peoria, Illinois, where there's a problem, we're going to have a different situation. And these guys are going to be forced to cover these shorts, and they will do it quickly and violently. And that's something where we need to be paying attention. Listen to the podcasts every day, because these rallies, unless we have funds actually building a long position, these rallies will be short-lived. Meaning, once they're done buying and covering it, we're right back to the same problem we were in before.
So
So,
there's going to be something pretty important here, Sterling, and that's the ability to recognize when these rallies happen and what are out there. And a former employee of the company, Lee Lamb, he helped develop something we call the action indicators for a lot of years. And those action indicators, this is actually one of them, was the spec fund position. And I think he did a really good job of illustrating. If you were ever in one of Lee's meetings, you were never bored, I can tell you that. And he did a great job of putting these things in common terms. And Sterling, if you don't care to put your cursor on that zero marker on your chart right now, if you envision this chart as your fuel gauge on your car, and that zero is right at half a tank. You've got half a tank of fuel right at zero. Lee used the illustration of this fuel tank, and when the fuel tank was towards empty, it was a buyer's market, not a seller's market. You did not want to be a seller when those funds were short or close to empty. But when you moved up to the top and you crossed over that halfway line and you got towards full, that's whenever kind of the common Joe could take a look at this and say, okay, this indicator of spec funds, this fuel tank is getting closer to full. And if you really put a price chart with this, and I'm not asking you to do that, Sterling, but if you look at those yellow lines at the top and you look at the green line as it started off here, guess what? There's a good correlation with price. And so we've got to watch this. When we get back up over that half of a tank towards full, we need to be thinking about selling. That's one way to really know when the timing is right. That's one thing. Now, certainly a lot of folks want to tie this with something else. And another one of those indicators, I'm going to kind of have you ad-lib here a bit because you may have to pull up another chart, but we look at a strength index. We call it RSI. RSI is another one of those indicators that we really need to watch. And in conjunction with spec funds, it's pretty valuable. And, we are reverting to what I call a normal market. A normal market doesn't give you an opportunity to sell your commodity every day. And to Sterling's point, do we panic? No. What we have to do is we have to pay attention to the signs that we're given. Sterling, do you care to give us a quick definition of RSI and kind of show how it is, how it works on a chart?
Yeah, these are in the DMOs on Monday, Wednesdays, and Fridays on a weekly basis. And this is an oscillator. It measures overbought and oversold. When we are approaching the red, that's a warning. That means buyers beware. We are reaching a high level. When we get below the green, that's sellers beware. We may be getting a little bit short. And as you can see right here, we got a little bit short and we got a little bit of a bounce. And here, just over the last couple of days, we've turned green. And now what I do when I make my commentary, I use a VWAP study, which I look at volume and at prices, and I'm trying to detect by the actual amount of trades and how the trades are happening, if it's funds or if it's just random business. And I would be probably willing to guess that somewhere right in here today, we're starting to see funds coming back in here and covering these shorts. Because remember, when we look at this net long position, this happened, big peak. We started, well, here we'll look at this most recent one. This happened about April 7th or so. Now we go back here on this chart. Where were we on April 7th? Oh, we were right in here. So 570 a bushel. They've got 70 cents made. That's 3,500 a load. If you're a decent fund trader, you're probably trading 1,000 lot. You have money made. So you are going to be very careful about guarding this money because you don't want it to slip away from you. And that produces buying and can produce a rally. Now, this could get a little tepid in here, but if we can get some news, we've compressed prices down here very nicely, and we can get a pretty good little bounce out of this. And the next thing, what I do to come up with some ideas about just how high we're going to go, we did a little Fibonacci on the most recent move. 534 would be a key level. 545, trade above 545 would actually be bullish, but we could probably expect to bounce back to that 534 level.
So when we look at this RSI, there's some numbers associated with it. It's on a scale from 0 to 100, and RSI, in simplistic terms, looks at momentum in the market, and we want to be a seller when we've got a strong momentum. I always kind of look at it like a football team, Sterling. You've got a football team, and you've got this big fullback, and he can punch his way for 4 yards time and time again. That team's got the momentum driving down the field. And we look at, just like we looked at that fuel tank, we look at kind of that number 50 is kind of a neutral number. And you can see Sterling's got at the bottom, you can kind of see this 0 through 100. We want to kind of pick a time when this market might be 60-ish and above. Different thresholds, but we certainly want to be a seller when we have good momentum or a higher RSI. And right now, the market, like we've talked about, is screaming, don't sell me. Don't sell me right now. It doesn't mean it can't go lower. It certainly can, but the indicators are not there for any kind of sales as of yet. Again, we're going to have to pinpoint this thing. We're going to have to be pretty precise. Let's use some of this information. Sterling's emails have this in it every day. Our ASNA Edge group puts these together. Each day, you're going to find a little bit of information that's going to help you make these decisions. If we see the stars align, we will be the first one to throw some information out there, but read the emails. Take a look at these things like we're talking about today.
Yeah, and today this looks like, and you know what they say about people who pick bottoms, but this has the behavior of making a bottom. Does this mean we can't go lower? No. Does that mean we could turn around here? Yes. Now, if we can hold these gains today, trade higher on Friday and subsequently higher on Monday, that would be a little more meaningful bottom. And that again, if we can get back up into here, the 545 area is going to be an area of contention, I think, for the market, because we will be right underneath the old support at 550, which is now our new resistance level. And remember, bear market rallies are very short-lived. And we are, for all practical purposes, I don't know if anyone's waved the bear market flag, but this is bear market behavior, and we are in a bear market in the grains right now.
So we talked about corn, sterling. These same principles apply in almost every commodity that you take a look at. If there's not anything else on corn, maybe we ought to take a look at soybeans very quickly. We're at the 9:30 mark. Anything else worth mentioning on corn?
That is a story on corn. And if you look at soybeans, again, we got noticeably, if you start to see these big green pockets form, right here's a beautiful example where we got severely beat up. We got a pretty nice little bounce out of the beans here. Here, kind of the same story, not quite as intense, but fairly intense. And notice today we made a new probing low, and we ran out of sellers, and the market's starting to bounce. And as we move up, that guy in Connecticut with that short position, he's losing money. Well, he's making less money. And you got some, Stephen Cohen's there whacking your desk with a ruler telling you to make money. That could certainly propel some buying here, because it does look like right at the moment, and I mentioned this in the podcast yesterday, that we were getting very, very stretched on the downside.
All good stuff. So our bean situation is this: old crop, you're probably going to see some opportunities. A lot of that's going to come in basis. Crush margins are still very, very good across the country. There's still some hope there. New crop, this is pretty demoralizing. Sterling, what's happened to us here really since just February, not that long ago, we were close to $14. We're down this low. It just seems, without looking at anything technical and just looking at the market in general, our tight supply, our extremely strong processing margins out there, it seems like this market does have some type of bottom to it that it can't exceed for very long. Aren't we getting close?
I think we are feeling around and finding a bottom. And export sales came out today, and they were terrible, except for one item: soybean meal. Our crushing capacity, we're doing better. Soybean oil being used in biodiesel more and more is something that will help keep soybean stocks and supplies, which are inherently tight anyway, tighter, and that will help create some opportunities here. And one thing, funds, when they trade corn and beans, they tend to trade with one brain. And if we can get the beans going, the beans can drag the corn along, kicking and screaming.
Sterling, one thing to kind of relate that to the spec fund positions out there, very few times do you find a fund buyer or seller that pinpoints a commodity and only does corn or only does soybean meal or only does wheat. In a lot of cases, these are basket purchases where you're buying a basket of commodities, you're selling a basket of commodities. So to Sterling's point, strength in beans may mean strength in wheat, may mean strength in corn as well. Those funds have a tendency to kind of move together. Not always, but they have a tendency to ride that wave. In regards to soybean meal, Sterling, we've talked about a good crop of corn in Brazil. We've talked about, we've heard it a record number of soybeans, mainly because of the increase of acres in Brazil. But that was not the case in Argentina. How does the Argentina disastrous crop play into this meal demand that we're seeing out of the U.S.?
Argentina is a major exporter of soybean meal, and they may actually be forced to import soybeans from Brazil for their crushers to meet their contractual requirements. That is good news for U.S. crushers. That means, we are seeing countries and regions, more importantly, particularly Northwest Europe, being the Netherlands. They're not using all the soybean meal in the Netherlands. They're bringing it into the port in Rotterdam and selling it out to the rest of Northwest Europe. If they can't get that, they are going to need that meal, and we will be the meal provider. So that is something that will, in fact, help keep soybean meal prices fairly stout and keep crush numbers running at a fairly healthy pace. One other thing that could help all of this, and you're not going to like this, so don't throw eggs at me, but if we could see a rally in the price of crude oil, that will attract investor money into commodity index funds. And index funds are different from the funds that I track. The funds I track are individual trading funds, and they're doing their thing. Index funds are like buying an S&P index in your stock account. You're buying a whole portfolio of commodities. That money flows in because people want to buy crude oil, which is the head stooge. That will pour more money into the commodity space in entirety, and that will serve to lift things. That will also help the price of soybean oil go up, which in turn improves crushing margins. We're not going to have a problem offloading that meal. So that is one other thing that can work to help us here.
The energy market is just a giant. I was naive, Sterling, when I started my career as to how big the protein market was. I was a big player. I was doing hedging for a handling company, dealing with futures. It kind of felt like you were big time. And all of a sudden, you take a look at how big that energy market is, that crude oil market, and it absolutely dwarfs anything that we trade in protein. When you think about the profits from some of the world's major oil companies quarterly, and you take a couple of quarters and you add those together, and you realize that the profits could purchase the entire U.S. corn crop, you start to see how the size and scope compares. When you get that money coming in energy, again, it's a commodity, not necessarily energy. You're going to get a few of those crumbs fall into the protein market as well.
And something here, we're going to put up a chart of crude oil because I want to use this as a teaching moment. Right here, we can see this is the price of crude oil, and we had held up a reasonably good range between 70 and 82. See this day right here where we dropped to $63.90 a barrel? That's panic. That's the real thing. Okay. There is some poor slob down here who sold crude oil at the low at $63.90. So as you can see, we made that 3-day pattern. We kind of shook it off, and we're starting to form. We didn't see quite the same thing with the corn, but it looked a little bit like this in soybeans, where we are actually trying to form something that looks a little bit like that today. But markets do always overshoot, and that overshoot is too much panic on the downside and too much confidence on the upside. So the fact that this is starting to trade and perform a little bit better, while none of us like to pay for gas at the gas pump, if this does move, if we can see crude back up here trading north of 82 and get into a bullish market, that will pour some more money into the commodity space in general and will help to alleviate a little bit of the pain, or at least mute the pain a little bit.
Sterling, we had a question come in, and if you don't care to switch back over to that November soybean chart, let's take a look at that. And as you do, the question is, what are some target zones to look at to sell November beans? Where are our next resistance points at? What do things look like right there?
Okay, so here again is today the overshoot. That's the first question. And let's pull up here. Let's see, grab. We're going to use this area right here. That was the most recent high. Go down to today. Whoops, hold on here. Annotate, retracement. And we're going to go right to here. Your first area, if we can clear 1313, that would be good. Your next area, 1237, 1256, and 1250 is the resistance area. That will be the point of contention if we get back up there. I'm a big believer in incremental selling. I would not be too upset if 1250 works for you. That's probably going to be a good area unless we can really blast through it. And then if we start to move up again, 1275 will be the turning point, as it were. If we can trade above that, that will be an indication that maybe we're entering a new bullish phase. And again, if we go above that level and start to come back through it, again, that will be your sign right there, especially the 1275 area and this 1256 area. If we bounce to 1260 and start to turn back through it, that 1250 area is going to probably be pretty good from the short side. And that will have this oscillator pushed back up much closer to the red line there.
Yeah, good the illustration technically. Again, look at those indicators. Those indicators can give you a better idea of, it sounds as if we're talking out of both sides of the mouth. 1250 is a great time to sell, but if we're at 1275, that's our blast off point, right? Like another reason to watch those indicators. That's going to help you a lot.
Yeah. A weekly close back above 1275 will have a story behind it. We will have put 85 cents in the market, and there will be something going on, and these moving averages and the temperature of the market will have changed significantly.
Sterling, I want to revert back to our earlier conversation, but when you look at this last 36 months and how good things have been, we've really not lost worldwide. We've not lost any demand. Actually, we've built demand year on year. The thing that's happened is we've had really kind of an event that's unprecedented, at least during my lifetime, in the fact that we haven't had good crops or unable to get crops out of production areas in the world. I mean, you take a look at yield trends in the U.S., Sterling, 2 of the last 4 years, we've been below trend on soybeans, 3 of the last 4 on corn. South America, really and truthfully, outside of the Brazilian crop this year, 2 of the last 3 years haven't been great. And then you throw the Ukraine mess in there. A lot of this has been created initially by really strong demand, but then all of a sudden we weren't able to meet it. And not only were we not able to meet it, we didn't produce it. So, we're making the assumption again that we've got this template built for what we're going to yield and what we're going to plant. Big question mark. We have not lived up to those expectations over the last 3 years worldwide. Any problems that we see can change this chart tremendously.
Exactly. This market is now, we've come down, and last week the funds were a net positive in beans. I can guarantee you the report tomorrow will show a negative number, and they are going to be sensitive about that. So that can induce, some noticeable volatility coming into the market. And again, this is really going to come down to weather and how well the U.S. crop performs. Next year's ideas for Brazil from the USDA are nutty. 162 million tons of soybeans. That is a huge jump. And usually they overestimate what they're going to produce. This was the first time they got it right. So that number is a big number, and that number is weighing a little bit on the market right now. It's a long way from even getting planted, but that number is, again, taking out that risk premium in the market that we're going to need to get prices moving higher.
So on paper, we've got big supplies. We'll see what happens whenever we have to tangibly raise those crops. Sterling, we've got about 15 minutes left. I've had a text come through from one of our listeners. I want to make sure that we do talk about wheat as wheat harvest nears. There is some concern here. How in the world do we market this wheat crop? I know you've got some closing thoughts on soybeans, but I don't want to leave those folks out on wheat.
Okay, let's start with the leader of uh the wheat crop here. Let's pull up Kansas City wheat, which has been the star performer. And as you can see, we've had a very good rally. We've also had an extreme rally in the Kansas City Chicago wheat spread. It has gotten way overdone, and I'll bring that up here real quick here. Let's bring that up. And make sure to read the Wednesday version of the DMO because I throw in a whole bunch of stuff, including things like the Kansas City, Chicago wheat chart. And let me find that here real quick here because this is. So yeah, I'll just punch it up here. That's
While Sterling pulls that up, basically we're just looking at the difference in prices between Chicago and Kansas City, and there's a big one. There is a big one, and I think Sterling's going to take off on the angle of these short Chicago funds here in a little bit. But let's take a look at this spread.
yeah, this has exploded higher. Down here in the lows, we were trading at $1.31. We traded all the way yesterday up to a high of 275. So this spread has made $1.40 a bushel in barely 2 weeks. So I think a lot of what you are seeing going on today in the wheat market, particularly if we look, Chicago's down 14 and three quarters, Kansas City is down 28. You make $1.40 in a spread in 2 weeks, you are going to take some of that money home invariably. And I think that is what is going on today. The wheat tour is going on right now, and I just got the first little bits of snippets on that, and we're looking at the lowest yield since 2003. So the situation hasn't changed, but the market's behavior has. My worry with Kansas City, this $9 level has been a real problem. And as you can see yesterday, we've traded all the way as high as 918. Outside day down close, which is bad news, and we're getting beat up again today. If we can get this market above $9 consistently, that will help out corn and soybeans and obviously be a good thing for the wheat. The wheat is going to be tight in Kansas City, but I was just looking at basis this morning, and basis really hasn't improved that much. Millers have learned to adjust, their blends, and they had to during the pandemic because you kind of had to work with what you had. So that is making the futures market a little less sensitive um, to the deviations that maybe we've seen in the past. And if they can get away with doing this on a continued basis, that may work to flatten out the wheat a little bit over time.
One piece of advice that I've been giving to especially soft red producers that call in, Sterling, is we're creatures of habit, and we like to harvest wheat, and we like to put that wheat in the bin, and we like to have that wheat moved out before corn and soybean harvest. So we've got that storage for corn and soybeans. I think we've really got to rethink that. And I don't find favor with too many producers. They don't like this. But to your point, the wheat buyers have adjusted. They kind of know the season that wheat is available. Commercial elevators place wheat in storage and they hold it for 6 to 7 months. And in a lot of cases, make more money per bushel on carry than any other commodity that they've got. As a producer, we have to look to play that same game. Putting wheat in the bin from July to January, even though it displaces corn and soybeans, has got to be something that you preach to these producers. I see some agents on here from Indiana and Illinois, Autumn and Aaron. I see you all on there. If you want to do, your farmers a favor, I really would encourage you to talk to them about placing wheat in the bins. Look at that carry-on basis alone, and it should pay off more than corn or soybeans. Good luck on getting them to do it, but but that's something that we really got to take a look at.
Yeah, here you can see right here we're 611 nearby, 656 out to March.
So that's just in futures. So you've got 45 cents in futures, and basis you could see as much as 30 and 40 cents. So when you
Yeah.
put those two together, you divide those by the number of months. You generally won't get that payout for soybeans or corn if it's not locked in. Just food for thought.
Yeah. The market is going to pay you to store the grain. Let the market pay you.
Erin makes a good point on the chat. She talks about, having a year-round buyer, and that's tougher and tougher to come by in soft red country. You almost have to establish those relationships with processors. There's not that many soft red wheat processors scattered around the Ohio Valley and the lower Mississippi, but finding those, and you can usually find an attentive audience. Maybe not for big quantities, but if you play this game, you'll find somebody that will be a buyer. It may not be the traditional elevator, and again, that's a tough one to get past farmers. We're kind of creatures of habit. We want to haul into the same place year after year. Going to have to get out of our comfort zone a little bit there, I'm afraid, on this wheat market. When things are tough, we have to be creative. We have to do things slightly different. And that's the challenge. It's not much fun. It's not much fun, but we've really got to look for these opportunities. You got to look a little harder.
Yeah, yeah. This year particularly, we still have the formula for volatility because we're still coming off of tight supplies. And let's talk about something where there's a little bit of hope here. Put up a chart of cotton. Cotton has been caught in this range since November, and we haven't done too much. But as you can see, yesterday we actually had a good day, and today we're getting a little bit of selling pressure. If we could get the cotton market back above 90, I think we do have a little bit more upside here. Perhaps we will see a little bit more discretionary spending in the apparel space. That is the biggest problem with this right now. Also, if we can get China's reopening to happen a little bit quicker, which we did see extra U.S. crude exports into China yesterday, that may be something that can certainly help the cotton if we can get them back to work and producing more T-shirts, as it were.
Sterling, just looking back, and again, not really overlapping charts, but it certainly has seemed as if cotton has kind of been a precursor to other commodities movements. And I know that they trade on some unrelated fundamentals to other proteins because we talk about the clothing market so often. But if you go back and we took that chart back, you're going to see cotton and in some cases wheat kind of lead this big jump, and you say, what in the heck's going on? And then there's a lag, and then we see our corn and our soybeans move up with them. Any hope that that's the case?
Yeah, that's one thing where cotton is a sign of good consumption. When people are buying clothes, that's a sign of good economic news. And that means they'll be eating more, consuming, more protein, i.e., beef, pork, chicken, which is inherently good for our market. And as you can see, these two they rhyme a little bit, but here we've seen the stock market has been very stuck right here, and we have not been able to take out this 4,200 level. Confidence is developing that we are not going to default on our debt, which we are not going to default on our debt, folks. That is not going to happen. But if we can keep the wrangling to a point and maybe take some of the steam out of interest rates, stock market goes up, that creates a wealth effect that kind of works to kind of push everything else up. It's very hard to get a commodity rally when you have a bearish stock market.
Sterling, I couldn't help but think, I don't follow these to the point that you follow them day to day, hour by hour, but it seems as if there is a lot of cash on the sidelines, some uncertainty as to where that's going to flow. Is that going to flow into more of the commodity sector? Is it going to go back into more of a traditional equities find? And some of that may be due to these interest rates where they're at. T-bills CDs at the bank. I think there's got to be a fair amount of that money that's tied up there. Hopefully, that's not tied up long term. What are you seeing there?
Well, if we take a look here, and I'm going to try and let's see, if we look at a T-bill here, we're going to look at a 1-month T-bill right here. This is the amount of interest if you want to lend your money to the federal government for 1 month. They'll pay you 6.55% on an annualized basis. We're going to take this chart. We're going to go back in time. Oh, we're going to go back to, actually, I'm pretty close here. Let's go back to 2000. As you can see, we actually printed above 7% a few times. This money's only sitting for 30 days. Okay, and okay, 7%, that's good. That's the highest we've ever seen a T-bill yield, I'm pretty sure, at least in recent history. So this money, there is a mountain of money right now that's sitting here collecting interest that is going to be looking for a better performing home when it feels confident that we are going to see a better performing home for it. So there is money. Again, we're going to need a story to get people to move out of this, and S&P clearing 4,200 would be one thing. That would probably lift crude oil, so that would take some of this money out of this and get it back into more risk assets as opposed to just sitting here on the sidelines. So there is large amounts of money looking for a home, and eventually that cork will pop. If Powell said he was going to come in here and cut interest rates, that would pop the cork in a big hurry, but I would not count on that just yet.
One thing that may be happening, and this is something that, as Sterling mentioned, we haven't had these opportunities. If you've got a brokerage account out there, a commodities broker with a Series 3 broker, there's something that doesn't come along very often in history. In that account, you can actually trade all your bills, your bonds, your T-notes that are out there. You can also trade S&Ps. And along with all of your commodity futures and options out there. One thing that's kind of unique about this market, and you're going to have a lot of people argue with this statement, you can actually place that money in your account in a T-bill, T-bond, T-note, and use it while it accrues that interest to trade other positions. So it's kind of a classic example of leveraging a dollar. In my mind, leveraging a dollar was simply borrowing money and buying something with it. In this case, you're using $1 to do two different things. Very, very unique opportunity. Personally, I do a little bit of that, but it's the first time we've had that opportunity, Sterling. Kind of unique.
This creates a way to create a synthetic 60-40 portfolio, meaning, the normal portfolio is your 60% stocks and 40% bonds, which I am not against right now. I think we have a good time for that. But this is a very unique opportunity in that you can have 100% in cash in a T-bill for a 12-month T-bill that's probably yielding, I'm going to guess just off the top of my head, about 525. And you could buy micro S&P futures, or if you're really brave, what used to be called the E-mini, and create a synthetic version of that you can trade in a rather nimble manner. And no, again, I put these in the Tech Tuesday, and I put them in for the S&Ps for a reason. One, the biggest markets matter, and two, this is something that you can take advantage of and can enhance some yields as long as you don't get carried away. That's all I ask.
Sterling, we're almost to the hour mark, and I've had a question come in via text, and also a good point that Aaron made in the chat box. The indicators, we talked about those. We talked about Lee Lamb, a couple of them we've talked about today, the spec funds, we've talked about RSI. They do work. And then the next question I got, it wasn't on chat, but it was on text. Why don't we have them anymore? Sterling and I have talked about this. The last 3 years, those traditional sets of indicators really haven't moved too much. So in other words, they basically indicated that every day was a good time to be a seller. Kind of illustrates our point, right? Every day is not going to be a good time to be a seller through here. We're going to have to pinpoint those. And to Aaron's point, they work really well in a market like this. Not so much like
Yes.
what we've seen the last 36 months, but what we're coming into, they do. And I'm getting a ding here if you can hear it. You know, what were the indicators? Well, we went through two of them, right? Spec funds, RSI. The other two, one of them was a little bit ambiguous, but it's probably the most important one. That's profitability, Sterling. If you can profit, if you know your numbers, you know, obviously selling something becomes a lot easier.
Right.
The fourth one was one that was created internally, and essentially we have our projected price, and our projected price in a lot of cases is our February average. This year, 591 December futures is where corn is. At a certain level above that, 10 or 15% gain above that, we looked at that as kind of the fourth indicator. So for the question there, those were the four that we've had traditionally. I don't think we bring them back at AgriSompo in a formal nature. But again, Sterling, you cover every single one of these in daily emails.
Right. And the Tech Tuesday is essentially a deconstructed version of this. I take all the parts, and all the parts are right there. You can see the fund position, its net position on a seasonal chart, so you can know where we are for the time of year. The RSI, or in that case, I use a stochastic, which is the same thing, only different. And then the RSI is on every other email. So you can see the deconstructed version of this and actually see how the parts are interplaying. Your profitability, you know that. And if we know what the projected price is, and you know you're north of that and we're in a choppy market, well, again, here's your sign. You know, that's letting you know.
Yeah. Sterling, we got a lot of things coming up. Again, if there's ever been value to the ASNA Edge material, it's over the next 90 days. If you're an agent on here, stay tuned for some specials that we're going to have. We're going to kind of condense what we talked about today in about 10 minutes over the next couple of weeks, so you can send that out. This is a chance for you to kind of rise above your peers, knowing some of this insight. Get them signed up for these emails, okay? Read them every day. We've got a few things coming up, Sterling. We're in May right now. Not only we have a June marketing meeting, we've got June WASDE, we've got a June 30th acreage report. It's going to be kind of the first domino to fall. We have all these unknowns out there. It's going to be our first known for this puzzle that we've talked about. Anything else you can direct their attention to over the next 45 days that you can think of?
The next 45 days, it's going to be about weather. It's going to be about weather, and it's going to be about weather. If the situation right here in Nebraska does not improve, that's going to be the first takeaway from that big production number. That's going to be the first thing. And then if we could maybe see the dollar index start to drop a little bit, that would also help us and give us a bit of a tailwind. So right now, the last 36 months, we've had our own bullish markets and our own bullish stories, and that's been supporting prices. We're going to need some help this year.
We are. You know, Sterling, my daughter heard me make the statement the other day that the highest yield potential, and this is an old farmer adage, the highest yield potential for an acre of corn is when the corn is still in the bag. And that's essentially where we're at right now. We've
That
got the
is
corn in the
exactly
bag,
right.
and we put it in the field, and, you know, maybe we don't get some of it deep enough and it doesn't emerge. Maybe an insect gets another seed. Maybe a turkey comes along and takes that seed away with it. And then we've got weather to contend with, and we've got handling loss. So you got all these things that take down that yield. I kind of feel that we're at that point right now. I'm not suggesting that we're going back to the old markets, but I think we can kind of whittle some things down. We kind of created this corn in the bag scenario, best case scenario, and then all of a sudden we're going to start whittling things down. Hopefully it's not too bad. We got to keep remembering this. Farmers make the most money with high yields, okay? Farmers typically don't make the most money with high prices. So we need to keep that in mind here over the next 60 days.
Right. And if we could certainly see exports wake up, that would be also something that would help begin to replace the underpinnings of the market that we've lost.
That's going to be our, I think of anything that would surprise the market the most, of anything, it would be China stepping in and buying U.S. corn in the next 30 days. And that has to be a springboard for some other things to happen. So let's keep our fingers crossed on that one. Not
It
likely,
could
but possible.
it could be China, or it could be messy. We can't get corn out of the Ukraine. Corn supplies get tight in Europe, and all of a sudden, the Netherlands become our best friends. That's, one thing that is a distinct possibility, that, you know, they don't want to ship it as far. So obviously you'd get it from the Ukraine. That's something where things could tighten things up a little bit, because China is going to absorb a lot of that newfound Brazilian corn. Um, so that is one other possibility, that it's not China, but the rest of the world has to come in and buy corn, simply because the global pot, more of the Brazilian pot, is going to China instead of the U.S. Somebody else is going to have to come in here and buy it.
Another point of optimism to that is the quality of that corn. EU is
Yes.
a quality buyer. The quality coming out of South America is relatively good because it's newer corn. It's most recently harvested. That Ukrainian corn we talked about, some of this corn that's on hand may be a 21 crop. You
Yeah.
may not have run good air on it. You've got insect issues. There may be quantity, but there may not be quality. So it's going to be interesting. I couldn't help but think, Sterling, earlier on, and we'll wrap it up here quickly. Some of your quality buyers jumped in line in Ukraine. We saw Japan, we saw China and South Korea buy Ukrainian corn 30 to 60 days ago, which really wasn't the time period they did it. I've got a feeling they may have done that for quality purposes.
Yeah. And if they've come in there and taken out the quality corn, that's going to leave a quality void. And we will see Japan and South Korea are very good buyers of corn, as is Mexico. And if we can see, a little peace at the border in Mexico, they're having their trade row over the GMO stuff. They will get over that too. That they're not going to stop buying corn from us any more than we're going to default on our debt. That's something that will take a little bit of that pressure back out of the Bears windpipe right now.
Well, I appreciate everybody joining us. We've kind of passed that hour mark, and I know that everybody's got things to do during the day. Hopefully, you took a little bit away from this. Again, we're going to keep you up to date with things, maybe some weather updates that we don't normally put out there, and certainly something kind of a special report on markets here shortly. So hang with us and pay attention for those to come out. With that, Sterling, I'm going to sign off. Any final words from you?
Um, yeah, wheat's back down again, but everything else is turning green. So the markets are shifting and moving. And I hate to cheer for higher crude oil prices, but that's something that probably will help us.
All right, everybody have a great day, and we'll see you on the next report.